Volatility control is a big deal. Hi, Paul Mauro, Smart Financial. You know what volatility control is? It's just cutting off some of the top and bottom of the wild swings in the market. You know what's hot about this is that actually volatility control mechanisms can sometimes increase the rate of return on certain indices, and we can show you that. You know what's interesting about indices, whether it's the S&P 500, the Dow, the NASDAQ, all kinds of other indices, as they float around with the ups and downs of the market. Imagine for a second if when the market goes up, your index goes up, and when the market goes down, it's frozen. That is a common volatility reset. So it means that you keep your gains, or most of the gains. You don't get all the gains in the market, but you have zero losses. And those zeros become your hero. So volatility controls, which are actually in action with Fidelity Excess Return Index and the S&P Global Return Index. These are common indexes that you're familiar with. You can get those indices in a lot of products with volatility controls and annual resets. Now, let me tell you the power of an annual reset. We've had a wonderful bunch of years in the market. So when the market's up, we're all going up. Now, you have to ask yourself, is it worth it to me when the market's going up, a record, say 15% a year over the last 10 years, is it worth it for me to live with maybe 12% instead of 15%? Is it worth it for me to take a little bit less up? Because when the market goes down by 30 or 40%, my account's going to be frozen. I won't lose any money. This annual reset is super important. It means every single year on your annual anniversary of your account opening, your gains are locked. Gain locking is really hot. And it does increase the rate of return on certain indexes. This message is primarily for the people that are 50 to 80 years old, that are more balanced investors, more risk management oriented. When you're young, you take chances. When you're old, you take care, right? When you're young, you take chances to make money. When you're old, you take care of your money. This is really different. From 25 to 50, that is the taking risk time of your life. From 50 to 80, it's the taking care portion. So I'm speaking specifically to the over 50 crowd who want to preserve what they've made, who can look at market history and say, holy cow, there's been a lot of downstrokes in the market of 20%, 30%, 40%, and as we all know, 54% in 2008. So let's just be smart about this. If you're an older investor and you have a great allocation and you want to basically give up a little bit of gain to have no losses, you are in the volatility control space. So to find out more and to download our handout on volatility controlled devices, go ahead and reach out to us, subscribe to the channel, leave some questions, concerns, or comments, right? Forward this to people that you know that are over 50, right? This is not a good technique for the young people. They shouldn't be afraid of the ups and downs in the market. If you're only 20, that means you just kept investing in all that down market time. And by the time you were 30, the market was back and your account was back. If you're grown up, invest like a grown up. Invest your age. Don't invest like you're 20. And if you're 20, don't invest like you're 80 years old. Investing like your age is just part of the art of being smart.